pleased to be with Trey Reik, all the way in Connecticut, Senior Portfolio Manager of Sprott Asset Management USA. Trey, thank you for being with us.
Sure, thanks for having me.
Give us a quick intro to who you are for our audience.
So I'm a Senior Portfolio Manager at Sprott Asset Management in Darien, Connecticut. And we focus in this division on investment in gold mining companies.
So Trey, in the news, we always hear that the geopolitical tensions between North Korea and the U.S. is driving gold prices higher. Do you agree with that or disagree?
Both. I think that there are lots of traders that have a tendency to buy gold based on geopolitical events. Those happen to be very, very short-term focused trades, which generally unwind in a short period, say days or weeks. And I think that North Korea at the current time is much less important to gold being over 1,300 than a growing recognition that the Fed is probably done with this tightening cycle. So I actually kind of dread geopolitical events like the missile launch and the nuclear tests out of North Korea, because in my mind, it just delays everything. I think that what has made gold such an attractive investment for the last decade and a half is the ongoing, monetary debasement of central banks. And so when something happens, like a terrorist event or North Korea, it almost delays gold's true profile because you get short-term traders in there sort of disturbing the water. Fed has talked about raising rates now for 8 years and has been unable to do so. What we would posit is what is different about the current environment that makes consensus so convinced that the Fed can now raise rates when they've been unable to do so for the past 8 years. And if we go back even further than the past 8 years, say the last 35, 10-year yields have been in a fairly uninterrupted decline. And we believe that that is because the system, with that much debt in the system, can't tolerate higher rates. So each time we've had a backup in the 10-year yields for the last 35 years, it's caused a crisis of some sort, and then yields sell off again. So our view is that with this much debt in the system, it is extremely unlikely that we normalize rates on both the short or the long end without serious harm to the U.S. financial system.
Well, when is that harm that you're talking about happening, or what's your prediction?
So if we go back to, for example, 2008, non-financial credit growth in the fourth quarter of 2007 was about 2.6 trillion, and in the first quarter of 2008, it fell to 1.6, and in the second quarter to 1. And just that slowdown in non-financial credit growth back in 2008 vaporized the investment banking industry in the United States in pretty short order. So with this much debt and this much leverage in the system, any slowdown in non-financial credit growth leads to a default wave. The Fed's QE programs are really tacit admission of that fact, and really are designed to prevent or provide a bridge to the non-financial credit growth necessary to stabilize the debt pyramid when that non-financial credit growth can't proceed on its own volition in the United States economy. So I would argue QE has really been more than the Fed's concern about unemployment rates or rates themselves, has to do with concern over stress in the American banking system.
Now I want to move on to Bitcoin. Are you banking on Bitcoin at this time?
Banking on Bitcoin, that was cute. First of all, there's nothing that I wish I owned more than $1,000 worth of Bitcoin in July of 2010, because $1,000 of Bitcoin in July 2010 was worth a little over 100 million 3 weeks ago when Bitcoin hit its intraday weekend high of a little over 5,100. But having said that, the second thing about Bitcoin is that I do believe that the investment cues or motivations between those folks buying Bitcoin and those buying gold in some cases are the same. In some cases, it has to do with the desire to get a little money outside the traditional financial system. Then we start moving down the line on the Bitcoin side, and gold has a reputation for having tinfoil hat constituents. And there are certainly some people in the libertarian type of political and investment stream that really value the fact that Bitcoin allows you to transact with other people without a bank or a credit card, which can charge you high fees, and then they get hacked, like Equifax experience here in the past week. After that, I personally believe that the similarities between Bitcoin and gold start to fall off pretty quickly. And I sort of highlighted 4 or 5 areas where I think there's a big difference between gold and Bitcoin. The first would be, Bitcoin's really in its infancy. It's only been around for a couple of years. And I always remind people that Netscape was the unchallenged leader in the internet browser application for the internet. Similarly, Bitcoin is the now unchallenged leader in the cryptocurrency application for the blockchain. But that doesn't mean, first, that the blockchain and Bitcoin are one and the same, because they're not. And number 2, it doesn't mean that Bitcoin will be the eventual adopted winner. It's likely, because Bitcoin has a very substantial lead, and it's a very impressive use of the blockchain, which is in itself a disruptive technology. I wouldn't argue any of that. But what's happening more recently is not really a store of value as much as, potent speculation. So in my experience, moving around talking to family offices and endowments, I've yet to hear a single testimonial of, say, a very large family office where Bitcoin is perceived to be an appropriate store of value for millions and millions of dollars worth of accumulated wealth. I do know lots of people who have made lots of money trading Bitcoin, but I think that's really what it is. The second category, and I'll just list them, is the irrefutable nature of what gold is, right? Gold is immutable. It's an ounce of gold's always been an ounce of gold 5,000 years ago. Today, it will be the same from now. It's a very hard metal to destroy. It doesn't even melt under 2,000 degrees. Gold's gold. Bitcoin, on the other hand, is a sort of series of algorithmic, computer code. Yeah. So there are lots of scientists and technology geeks who might see Bitcoin as very dependable or very secure, but I think that it really centers.
There is this trust, though, in Bitcoin.
Trust is the third category. So in trust, there's no question the blockchain allows you to interact with someone you don't know in a trustworthy way, in the sense that they're, the transaction is memorialized to everybody for all time. And I understand that. But I think that type of trust is really sufficient for flipping around Bitcoins or maybe small purchases. It's unlikely to be the type of trust that empowers Bitcoin to be a store of, say, $100 million for state endowment or something like that. So, and the reason is that there is some sort of institutional or professional oversight that really lends that trust to those large figures. And then a couple of other small categories are mere volatility. It's not that gold isn't volatile on its own, but the moves that gold puts in generally take months and months and years to get to that type of a level. And so the volatility, I think, of cryptocurrencies belies their function as a store of value. There is also this perception that Bitcoin is, accepted in lots of. I've read once that there were 270,000 merchants that accept Bitcoin, but it's interesting that in the top 500 internet retailers this year, 3 of 500 accept Bitcoin, down from 5 this past year. So, there may be some pizza parlors and that type of thing who want to get involved in sort of almost a marketing campaign by saying they accept Bitcoin. But in terms of true commerce, there's very, very little, at established retailers that really comes. And then there's a safety component. I'm not saying that the safety issues with Bitcoin aren't more related to the internet than the blockchain. The blockchain is very steadfast, but there are a lot of Bitcoin wallet, internet, initial coin offering type soft spots, if you will, that have led to quite a few Bitcoin disappearing.
All right, Trey, so from your perspective as a portfolio manager, where do you potentially see Bitcoin going?
Mm-hmm. So that's an interesting question. The one difference, I think, between Bitcoin and cryptocurrencies in general is the hard cap, which in my opinion is intellectually attractive about Bitcoin. So the way it was designed, theoretically, there will only be 21 million units ever. And today there's about 16.5 million.
Right.
I don't know if you know this, but the mining rate of Bitcoin, I believe, is 16.5 new Bitcoin every 10 minutes, and that mining rate falls in half every 4 years. So it's sort of a complicated sine curve, if you will, that will get the issuance of Bitcoin lower and lower as we move forward. In other words, the inflation rate on the currency, and the attractiveness of that is obviously that's very different. If we look at global central banks just this year, through August 30, they've added 2 trillion in asset purchases. So Bitcoin is intellectually attractive in the sense that it is designed to prevent debasement from human stewards. The problem, of course, with that is there's now 1,160 in cryptocurrencies. So there is a hard cap on Bitcoin. There is no shortage of competing cryptocurrencies. Mm-hmm. In terms of where I think Bitcoin will go, I'm actually, I think, more positive on what Bitcoin represents than most gold enthusiasts. There's no question that it's an interesting portfolio diversifier. I would say more on the individual level than the institutional. And because the Bitcoin market cap is about 70 billion versus gold's 8 trillion, obviously that's going to limit it, its application, as a portfolio component or diversifier. Right. But I think that the chances of Bitcoin going significantly higher are high, but I also think the chances of Bitcoin going significantly lower are high. So you have to take both in account. I am convinced, having watched it pretty closely, that there is a J-curve type of effect. And by J-curve, I mean Bitcoin is given to these violent upswings. There was one in late 2013 where I think it was up 400% in about a month and then down 50%. Most recently, starting from the Japanese government's decision to make Bitcoin legal tender in March, starting in April, Bitcoin really went from 1,000 to 5,000, which is obviously more impressive than any other prior move. And we'll see where it balances out. I think we're sort of 3,500 as we speak today. And it's more than likely, in my opinion, going to check back to something closer to 1,000 than where we are today. On the other hand, if people really are long-term and they have the ability to buy a little Bitcoin and put it away for, say, 5 years, I wouldn't bet against it, because I think that, quite frankly, anything that has its, fine art, Honus Wagner baseball cards, fine Bordeaux wines, Bitcoin, anything with a limited number of units that can't be reproduced or debased is likely to be valued higher 5 years from now.
Right. Well, Trey, thank you so much for your insights today.
Mm-hmm. Thank you.